This next video takes a look just quickly at the effects of an inventory error. So if we have an error in our ending inventory, that's not the only error that exists in the statements. We know that there's a link between inventory and cost of goods sold. So when we have this error in ending inventory, it creates a whole string of additional errors. So we can see that here in this little chart that's given. So we're looking first at this first column. So if there's an overstatement in ending inventory. So let's say, for example, at the end of the year when the count is done, under either periodic or perpetual, someone counts too much. So they make an error in the count and we think we have too much inventory. Therefore, the value would be overstated at the end of the year. If this happens, we know that if you're doing the periodic method, we use this calculation for cost of goods sold, but it's the same idea for perpetual. You just don't see it, but you would make an adjustment at the end of the year to correct that inventory, and that would go through cost of goods sold. So in both periodic and perpetual, if you have this overstatement in inventory, it ends up, so we have that here, the overstatement, that leads to our cost of goods sold being understated. So remember that our cost of goods available for sale that you see here, whatever you had throughout the year that you could sell, it's either left in ending inventory or it's in cost of goods sold because you sold it. So if inventory is overstated, the amount that then is left to go into cost of goods sold is too low. So it's understated. So we then calculate our gross margin, which remember is sales revenue minus this cost of goods sold. So if we're taking away a cost of goods sold that's too small, we're left with a gross margin that is overstated. So it is too high. We would take away our operating expenses, those are correct. So because this gross margin was overstated, we also end the year with an overstated net income. So we're showing net income that is too high, and we have on the balance sheet this ending inventory that is also too high. Now it's the same idea, same flow when it comes to an understatement in ending inventory. So our ending inventory amount's too low. Because we have not enough in the inventory, it means we had to put that extra amount in our cost of goods sold. So now our cost of goods sold is overstated. It's too high. That leads to a gross margin that is understated because our sales minus this too large amount of cost of goods sold gets us to a lower or understated gross margin. From there, we take away the operating expenses that are correct, and overall we have an understated net income. So just having a count error in inventory leads to several things being incorrect on the income statement as well. Cost of goods sold, gross margin, and net income would all be wrong as well. Now we see here, it says that recall or think about that one period's ending inventory is the next period's beginning inventory. So if there's an error in our ending inventory amount, that also carries over into the next period, because the opening inventory that you start the following month or year with would also now be incorrect. And because of that, in this second period that we look at, or the next period where you had an error, if you count your inventory correctly at that point, so the ending inventory of the second period is correct, then you no longer have an error in inventory. However, the impact on your cost of goods sold, gross margin, and net income, it has to get fixed somehow to fix this ending inventory. and it actually ends up having the opposite impact that you had in year 1. So it has the reverse effect in the next accounting period. And this is hard. I know this is pretty complicated, so you need to have a little bit of an understanding of this, not in great detail. But just looking at a quick example here, let's just look at the last 2 months, so September and October. Let's say in September the inventory count is done and there's an error here. And we'll say that inventory was overstated. Someone counted too many goods, or they looked away and then counted the same thing multiple times, and inventory is overstated. We know that that then results in September having a cost of goods sold that would be understated, because those always go in opposite effects in the same period. So September, we have this ending inventory error, and we have the COGS that's understated. Now when we get to October, everything gets recorded through the month. They do a count at the end of October, and now the count is done and it's correct. So at the end of October, we're going to adjust that inventory, but we're going to put it to the right amount. To do that, we now need to take out extra from the inventory account and put it into cost of goods sold, because our opening inventory in October was overstated because of this error in September. So to correct that, we need to take away more out of the inventory account and we put it into cost of goods sold. So in October, we end up with a cost of goods sold that is actually overstated. So you can see that now we've got our correct inventory at the end of October, but we had this reverse effect in the 2 months for the cost of goods sold. So in September it was understated, but the reverse effect in October was that it is then overstated in the next period. So, moral of the story, if you ever have to count inventory for a job where you're working, or if you're an accountant and you're doing an audit, be careful, because there's a lot of errors that can go on in the statements just because a count is done incorrectly. And that can flow through 2 different periods as well.